The outlook for emerging market currencies in 2016 is going to be dominated by two key factors. One, of course, is going to be the monetary policy settings from the Federal Reserve, and we would expect the Federal Reserve to retain a tightening bias throughout the year. The other key influence, of course, will be the performance of the Chinese renminbi. Because of the significance of China in terms of dominating regional trade, the renminbi is understandably a key determinant of values for currencies across the Asia-Pacific region. And so for that reason, we do believe at the start of 2016, we may see a little bit of volatility as the market gets a bit nervous about the fact that the Federal Reserve is embarking on its first tightening cycle since 2006. But we do believe that as the year progresses, the relative stability of the renminbi, along with the fact that history tells us that emerging markets typically stabilise in the quarter or two after the Federal Reserve embarks on a tightening cycle, put this all together, and some emerging markets in Asia will start to look even more interesting as we move towards the second half of the year.
In this documentary, we focused on the investment risk that is posed by the emerging markets. Through this lens, we will show how the emerging markets have positively affected the investment risk in the global economy. To begin this documentary, we will start off by defining the emerging markets and investment risk. The emerging markets consist of 5 different countries: Brazil, India, China, and Russia. An emerging market economy describes a nation's economy that is progressing towards becoming more advanced, usually by means of rapid growth or industrialization. These countries experience an expanding role in both the world economy and on the political frontier. Investment risk is defined as the probability or likelihood of occurrence of losses relative to the expected return on any particular investment. Investment risk can be broken down into 2 different sectors: economic risk and political risk. Economic risk refers to a country's ability to pay back its debts. A country with stable finances and a stronger economy should provide more reliable investments than a country with weaker finances or an unsound economy. Political risk refers to the political decisions made within a country that might result in unanticipated loss to investors. While economic risk is often referred to as a country's ability to pay back its debts, political risk is sometimes referred to as the willingness of a country to pay debts or maintain a hospitable climate for outside investments. Even if a country's economy is strong, if the political climate is unfriendly to outside investors, the country may not be a good candidate for investment. We will also take a look into the relationship between the emerging markets and the United States.
The equity markets and opportunities are global in nature. If one just focuses on the U.S., they're making an implicit and large bet that the U.S. is going to outperform the rest of the world. If you just looked at the size of different regions in the global markets, the U.S. would only be 40% of a total global portfolio allocation, and 50% would be in the developed world and 10% in the emerging markets. When you say, well, why the emerging markets? They are the engine of global economic growth today. Their economies are growing faster than those in the developed world, countries like the US, Europe, and Japan. And they happen to have better fundamentals, better balance sheet fundamentals. That means that they're taking on less debt to grow their economies, and so that employs a different level of risk than you see in the developed world, where Europe has their debt problems, Japan has debt problems. And so that's a key characteristic, as well as the fact that they have much younger populations and very aspirational populations who are making less income than we do in the developed world, and they want to catch up, and I think many can and will catch up with us in the developed world over time. The emerging markets, you could say, have a higher element of political risk with less established rules of law. And I'd use 2 countries as an example. China, for instance, one. If a U.S. company goes to have operations in China, they often worry about intellectual property rights and will the Chinese company steal their ideas, their way of manufacturing, just because they have less established rule of law there. And then a second example would be a country like Argentina, which actually nationalized an oil company this year or last year, and that cause losses to foreign investors in that market because of that nationalization. So there is this additional level of rule of law being less well established that adds to more risk than you get in the developed world.
In this documentary, we will show the 3 ways in which we came to our conclusion that the emerging market has positively impacted investment risk in the global economy. The first of these is GDP. GDP stands for Gross Domestic Product, and this is the monetary value of all the finished goods and services produced within a country's border in a specific time period. GDP can help to gauge a country's economic health. GDP is a comparison between the country's health and the overall market. If GDP is positive, it will boost the confidence of investors, thus making them more likely to invest in these countries. On the contrary, if GDP is negative, then this may be a huge warning sign to investors, which will make them more hesitant with investing in these emerging markets. Each of the 4 countries in the emerging markets saw their GDP rise annually. In particular, China, whose GDP increased roughly 6 times since 2003. The BRIC countries have been experiencing an economical boom over the past several years and therefore have seen significant gains in the production of goods and services. Additionally, each of the 4 countries has had one of the top 10 grossing domestic products in 2004, producing more than developed countries such as Canada and Australia. Unemployment rates have also been correspondingly low in these countries, with the exception of India. China, Russia, and Brazil have maintained an unemployment rate of roughly 6% or less in 2003, indicating that their economies are still demanding workers in order to produce.
Let's talk about emerging markets, and I particularly am eager to talk with you about India because it's something you know a lot about. You just got back?
We did. We just took a group of clients there and met with leading CEOs and policymakers a couple weeks ago.
And what did you find?
We found reason to be hugely optimistic about India. And taking a slight step back, I just want to say that we do think that particularly U.S. clients should think about India in the context of broader emerging market exposure. So we're advocates of clients getting broad EM exposure, with India being an important part of that. We are very bullish on the prospects of India. Our trip to India reinforced our view that this economy has the capability of growing at 9 to 10%, and there's not a lot of that going around the world.
Where is it now?
The second tool we will use to measure the positive effect of the emerging markets is the political stability of the countries. Politics highly affects the emerging markets and are indicators to investors on whether or not they should invest in a certain country. If a country's government is helping to push the growth and making the strides that are necessary to help the economy, this could be a very positive sign to investors that they would have the support of the government to back their investments. India, which has been a relative bright spot within the emerging markets since the election triumph of their Prime Minister Narendra Modi and his party in May 2014, politics has presented a small risk to India, realizing its potential as a high-growth market. India remains a star within the emerging market world. In Turkey, the AKP's victory in legislation elections in November raised hopes that the resulting strong, stable majority government would have the political will to pursue the structural economic reform.
The Chinese Premier Li Keqiang's speech was to calm international investors. He said China will ensure its economy continues its stable growth.
I want to tell everyone that the trend of China's economy is featuring a slower yet more stable growth. It will move towards a bright outlook. However, difficulties remain. Generally speaking, opportunities outrun challenges. We will reach this year's major targets and ensure a better outlook of China's economy.
The third measurement is population growth of a country. Population growth can give investors insight onto whether or not to invest in these markets. All of the BRIC emerging markets have had consecutive quarters of good growth in population. Some of them, such as China and India, have seen large population growth over the last couple of years. These economies make up around 42% of the world's population, which is estimated to be higher than 7 billion. China and India in particular are highly populated. Respectively, they are the highest and the second highest population countries in the world. Out of every 8 people in the world, around 3 come from either India or China. All of the BRIC nations are characterized by the rising middle-class population and relatively young population compared to the developed world. Brazil has a median age of 30.7 years, while India's median age is around 27 years. Japan and Germany's median ages are higher at 46.1 years each. A young population means that there are more people working compared to a country with an older population. Also, a higher population means that there are more consumers. Consumption has driven India's economic growth for decades. China is now transitioning into a consumption-driven economy. The advantage of being a consumption-driven economy is reduced dependence on other economies' well-being for exports.
I've been watching closely the recent volatility in global financial markets. Our sense is that at this stage, these developments do not pose a substantial risk to the U.S. economic outlook. We will, of course, continue to monitor the situation. Mr. Chairman, let me add as an aside that since my appearance before the House Committee, a number of data releases have pointed to softer spending than many analysts had expected. Part of that softness may reflect adverse weather conditions, but at this point it's difficult to discern exactly how much. In the weeks and months ahead, my colleagues and I will be attentive to signals that indicate whether the recovery is progressing in line with our earlier expectations, under 6%. So 6.5 was simply meant to be the committee saying, look, if the unemployment rate is above that, we see absolutely no need to consider any possibility of raising rates. Below that, we begin to look more carefully. And as we do so, of course, the unemployment rate is not a sufficient statistic to measure the health of the labor market. An additional 5%, an unusually high fraction of our labor force is working part-time for economic reasons, which means they're unable to get full-time work but want it. That's an additional 7 million plus Americans who are involuntarily employed part-time, and we have an unusually high fraction of Americans who are unemployed and have been for substantial amounts of time. So, as we go to a fuller consideration of how is the labor market performing, we need to take all of those things into account.